Trump's Liberation Day tariffs nearly caused a flash crash in the after hours today, with the ES down over 100 points on the announcement. And if you saw the numbers, we're talking about monstrous tariffs here, far larger than the expectations of the market, that personally, I don't really think have any staying power here. And honestly, in a weird way, this could be bullish. We'll get into what I mean by that during the fundamental segment, but it is good to know that for now, the bear technicals are still working. So buckle up and welcome back to the Trade Brigade Midweek Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description and stay tuned until the end of today's show. I've got 4 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off on the SPY daily time frame chart, and let's begin with a very simple trend count here. We know that the highest high in the trend count is the all-time high. Then we had soft lower highs here, never really flipping into an hourly uptrend. We finally had an hourly uptrend. We did produce a firm lower high. And the reason I could confidently call this a lower high is because, of course, on the Monday gap down, we've actually produced a lower low in the trend count from here to here. It's an incremental lower low, but it's a lower low nonetheless, which means coming from the lowest low in the trend count, the market can afford to find another lower high and preserve the overall downtrend that we're in. And what you might recall from the Saturday update video is that the line in the sand, or sort of a key zone where that lower high could be found, is right up against the bottom end of the do or die zone at 565.50. Now, the do or die zone isn't just this fancy orange box on the screen here. The reason this exists is because it was the failure from the buyers to produce a gap fill reversal on the Thursday session of last week. It's the opening print, the origin, the scene of the crime, if you will, from the break of the hourly trend, which was up here, right? If we draw a trend line, we broke trend there on that exact level. And it's also a number of weekly confluences. Most notably, we've been referencing the weekly 50 SMA as well as previous structure off to our left. So the fact that even outside of the tariff announcement after hours, the market had already started to develop an upper wick on today's daily bar is an indication to me that sellers still remain in control outside of the tariff news, and the bearish structure is still in play. Now, to play devil's advocate here, we would of course have to change our tone if we got into the do or die zone and then started to break up and over the top end of the do or die zone. Why? Because of course, everybody can see this, right? This is not a special secret. Maybe it starts to act as a double bottom. But we're not there, and this is not a conversation point for tomorrow, at least as of right now. In the after hours, with the market trading a spread of 546.90s, give or take, that means that the forecast open is going to be somewhere down here, on par with the lows of the Monday session, if not slightly worse. So we're actually producing a new lower low if this gap down can stick overnight. And this is where we probably have to have a little bit of a deeper conversation here about capitulation and that twisted way in which this could actually be bullish for markets as we move forward. So let's break this down a little bit, and we'll do this in more detail again tomorrow morning as the pre-market prep kicks off as we get closer to the 9:30 bell, but let's just say that the gap down really extends through the lower edge of the weekly expected move. This is roughly 541.25. If that's the case, then what I would fall back on is the idea that these tariffs might be overblown, and the market works on expectations, right? If these tariffs are going to be used as a negotiation tactic, and hey, just like we sort of did on the first round, Mexico and Canada clean up the fentanyl inflows, and let's reduce those tariffs back down. It's not going to last too long. Don't you worry about a thing. Well, the market just got beat over the head with these astronomical numbers. The worst case scenario is almost priced in right here, right now. So if this is a capitulation style gap down, and these tariffs truly don't have any staying power to the degree that they've been announced, any walking back of the tariffs, in my opinion, would alleviate concerns for the market, likely allowing some sort of gap fade or some sort of gap close, some sort of rally, if you will, in the upward direction. Now, this does not just mean go out there and buy the gap down with both hands on Thursday morning, but it does mean be open-minded to the worst-case situation starting to be priced in, and if there are improvements, subtle improvements, the gap rules allow us to get long on a gap down like that. It's definitely a tactic that we should be aware of and some sort of trade idea we can build a thesis around. One of the easiest ways to think about this is just through the lens of trade location. If you're trying to spot a really great short setup, generally speaking, you want to be short on the lower highs. This allows you to keep your risk small while potentially targeting the equal low. This would have been the ideal outcome if the markets were opening up here, looking for a rejection to ultimately move back down towards the equal lows on some sort of intraday move. Now, of course, with the catalyst and the intended gap down that's brewing in the after hours right now, this has already taken place. This ship has sailed. So do you really want to be an aggressive new money short smack on the lows now that the bearish catalyst is already out? I don't really think that's great in terms of trade location here. It makes our job difficult, don't get me wrong. It doesn't change the fact that we're still in a daily downtrend. It doesn't change the fact that the bears are still in control, but it might not be the best location to initiate a new money short, right? So instead, how do we sort of develop a new short thesis? Well, number one, you could trade the gap rules in the upward direction to fade the gap and move into this set of lows here. I would primarily be using this 548.75. And then when and if a new lower high could be set up against that level, that's where you want to establish another short position. Be watching for something that looks like what? Something that looks like this, right? You close partially the gap. And I'm saying, like, clearly this would have to get much worse through the after hours to produce a gap down of an additional about 10 points in the S&P 500, right? Let's say that the Asia markets wake up and all of a sudden things are like horrendous over there, sell off this, sell off that. If that's the case on a capitulation style gap down, it will be severe, in which case we can look for the fade, meaning move higher first, and then reevaluate for the potential of a lower high here to preserve our trade location. Through this entire range on the screen in front of us here, I think if you've taken anything away from these videos, it's just the idea that regardless of how you feel about the current trend in the market, you can never, ever, ever sacrifice your trade location. Otherwise, you'll get the short end of the stick almost every single time, right? Anyone who is like, hey, look, we broke over the top of the do or die zone. Let's just start buying this up here. Terrible trade location, top end of the balance range, top end of the trend count, highest high. Just like in theory, if we open on a big gap down and this suckers in a bunch of new money shorts, that could be easily terrible trade location. The gap fades. These shorts who got in early, technically they get run over because they can't withstand the margin drawdown. Then up here is where the better short entry is established, and now we can actually manage risk more effectively. So if you take away anything from the video, I would suppose that's the primary thing here that I'm concerned with or will be thinking about as a top-of-mind idea as we come into the Thursday session, right? It's that the bear technicals are still in place, the trend is still down, we're getting the indications even outside of the Trump tariff catalyst that bears were in force up here producing that lower high. It seems likely that we're going to be opening at least an equal low, if not slightly worse, to a lower low. We could always play devil's advocate again and say, okay, what if we actually end up opening in here? It's not as bad as we think. Well, can you imagine what I'm going to say? I would probably still be favoring bearish setups, looking for either rally rejections again at the do or die zone low. I would look for some sort of rejection of this previous balance range. As a matter of fact, let's go down to the hourly chart now so we can have this conversation too. I would be looking for, if we open here, right, I would be looking for rally retest rejections of 559.75, bottom end of this balance. And then I would just be looking for equal lows as the possible targets, right? Primarily from back over here, 552.15, and then over here at the opening print-ish of the Monday session, 548.75. Again, this is if we open in range, but it seems very likely at this point we will be dealing with some sort of gap down, right? So that's how I would be playing this market there. Let's quickly take a look at the anchored VWAPs intraday, just to point out anybody who was bullish, anybody who was like, nope, this is it, it's got to be a double bottom from here to here. Well, ideally, you'd like to stay over this anchored VWAP from the Monday gap down. That's not really the case, right, as of what's going on in the after hours right now. And these things are still acting as resistance overhead here, and this is still confluence up towards the top end of the do or die zone, which would reinforce, in my opinion, a weekly lower high that is persistent, right? So that's it. It's still more bearish than it is bullish, but please, if there's a severe gap down underneath these equal lows, understand that your trade location is top of mind. If it is going to be a gap and go, it'll be a difficult situation to play into. Let's just say that we open here. Let's add one more scenario into the mix, because ultimately all we do as traders is prepare for scenarios and try to manage risk around those potential paths, right? That's why we do the pathing in the morning. So one more potential scenario, excuse me, would be opening in here towards these equal lows. Not a severe gap towards the lower edge of the weekly expected move, but rather just in here underneath the prior day's low, slightly higher than where we are in the after hours right now. If that's the case, I would still, and I'm sure you know what I'm going to say, right? I would still be seeking a lower high gap fill reversal all the way to today's low of day. I would be looking for sideways consolidation, that intraday Brigade bolts underneath the Monday low, the Monday opening print, 548.75. I would be targeting 541.25, and I would walk down targets from there. Depending on how aggressive the overnight trade actually gets, we could use the overnight low as a potential target as well if we end up opening slightly higher towards this 551, 552 zone that we're describing right now. You know where I change my tone on the bull side. I neutralize inside the do or die zone, and I become much more of a bull when and if the structure actually changes via some sort of higher low confirming that a double bottom is in force. But as we're about to see, I don't really think the supporting evidence is there for our buyers to make a strong stand. Let's start with our market internals. I have to give credit where credit is due. Looked decent on the volume inflows today. Looked decent moving from trend lower zone up here towards trend higher zone at minimum. Again, respect and credit where credit is due through the zero mark there and a firm close above. A little bit better than the wishy-washy sort of give back that took place on Tuesday. But where I think this just completely reinforces the idea that the bears are in control is take a look at these cumulative builds out of the tick. As a matter of fact, let's just include Monday as well, because it's been nothing but a counter-trend rally this week thus far. There is no cumulative build here out of the tick. So exchange level participation intraday. Remember, this measures from the previous day's close. This measures from the previous day's close. This, of course, is from the opening print. So we use this for day trading anyhow. Makes sense that this would be bullish. But if we're trying to assess what's happening across the exchange, is the breadth supportive of this advance we've seen higher? Does it look like new money buyers are stepping up? Broadly speaking, the answer is no when we evaluate the cumulative tick here and where the distribution has been over or under the zero line. Much more of a neutral and flat action here versus confirming the upside with strong tick impressions, right? And I'd say that Tuesday morning was a great example of this. If we just zoom in here, one of the things we called out and talked about was that Tuesday morning, there was about an hour of really solid looking plus 1,000 ticks. Now, the issue with that, of course, is that into the afternoon, you had equal, if not many more, minus 1,000 ticks. So at the exchange level, that sustained buying pressure was simply not sustained, right? So all things considered, new money buyers not here when we evaluate the internals from this perspective. Let's take a look at the market profile. If you're not familiar with the profile, check out the video tutorial in the top right-hand corner. I will say, again, I'll always give credit where credit is due. At face value, value quite literally was progressing in the upward direction. If we take a look at the single prints from the Friday session back here, the long liquidation we talked about, in theory, today's value area was above that level. There was a pretty strong opening drive here off of the opening low, and there actually wasn't much of a rejection around the key level that we've been using. We've been both using 5660 as well as 5700. Value was over the single print base from back here. So at face value, no pun intended, there were some improvements, but you could frame this two ways because obviously we know what's taking place now in the after hours. There's no secrets, right? Anybody who was posturing long, thinking that the market was going to break out, how are they feeling about their positions? Longs are feeling like this, shorts are feeling like this. So the fact that this value was over the single prints probably just indicates much more of a trapped overhead supply condition than any severe continuation in the upward direction seeking acceptance at these higher prices, right? Let's go back on over to the platform here. Let's take a look at our good friend, the QQQ NASDAQ 100, and see what's going on from this perspective. So daily chart is going to kick things off. Of course, similar commentary. Here's a high, here's a soft lower high, firm lower high, obviously a much more severe lower low. Again, credit where credit is due. The sellers really should have stepped up in two different locations here out of the NASDAQ. If I zoom in on this, let's take a look here as we expand this as such. The first place via the Monday gap down would have just been gap fill reversal underneath Friday's low. That would have kept us underneath the balance range here. The next place would have been respecting Tuesday's high as a firm high and not attempting a breakout over that during today's session, Wednesday, where you can clearly see we closed over 473.25. Now, not over the do or die zone low, which is at the 480.25 mark. However, stronger sellers should have stepped up sooner. This is not really the action that I would have expected, and the catalyst is almost in some sense, a get out of jail free card, if you will. And that's sort of helping out with the technicals. Now, of course, we could still argue that a lower high is still on the table, but even stronger sellers should have caused the rejection much sooner. Now, if we're thinking about where we're gapping down to on this, we have 455.25 by 32, which puts us right towards the lower edge of the weekly expected move, making a definitive lower low underneath the Monday gap down low, which will provide another lower low in the trend count. We can rinse and repeat the cycle. Where would I now use a line in the sand for the next lower high in the trend count? Here, has to be 467. If we open on a gap down, gap fill reversal is the next lower high. If the market rallies off of, let's just say, this theoretical low and accepts over 467, I would say third strike, you're out, sellers. Strike number one, not really seeing follow through after the gap down underneath the equal low here. Strike number two, not getting a gap fill reversal, not rejecting the bottom end of this balance range here. Strike number three is actually getting acceptance back into this range. So I would not, on the NASDAQ in particular, be as patient for waiting for a potential higher high over this level if the buyers can yield some sort of acceptance over 467 here before we even have the conversation about a test of this potential neckline. And you can start to see how this is not really a double bottom. Maybe it's like a lower low, a much lower low double bottom. I wouldn't consider it that. But you could start to say, okay, if we gap down, we get a rally, we accept back over 467. What have I just started to draw now? I mean, it might look a little convoluted, but there's your inverted head and shoulders, and we'll take that in stride when and if it is appropriate, based on the idea and the premise that now the cat's out of the bag, the worst of the worst has possibly been let out into the air. We know what the worst case tariff situation is. If things get walked back a little bit based on negotiations, based on like, we were a little overstated in our actual ambitions here, that's where things can improve, right? If things don't, and let's also be clear, like that's a very optimistic take. There's also a very reasonable situation where things do not improve. You continue to see, let's say we gap down here, gap fill reversal, and then we continue to see the markets move to the downside, just sustaining the downtrends that we're in. So let's not lose sight, and I suppose what I'll do just to recenter us here is that our base case for the NQ would be, or the QQQ cash here, would be that some sort of gap down brings us the opportunity for a lower high. And that lower high is ideally underneath 467. That's base case, right? Base case can also include gap and go. We open towards these lows. Let's just say that we can use Monday's low as a reference point. If we open above Monday's low, a break under Monday's low with a lower high yields continuation, right? Straight up opening drive, continuation, right? We'll look for downside targets. We know we have 451.15, and then beyond that, we have 442. So continuing the daily downtrend is the base case. The back burner idea, and where we're open-minded to things changing, lower probabilities given what we're walking through so far today, would be something that looks like this over time. 467 recapture. All right, let's go down to the hourly time frame chart. You can see it here, this initial rejection on the intraday, Tuesday, to reject the bottom end of the range. It was looking good. Today's open slightly lower away from the settlement of the Tuesday session was a great spot for the potential for sellers to provide one of these. An equal low breakdown again underneath 467 didn't happen. So once again, in that introductory comment or sort of conversation on the NASDAQ, we have to give credit where credit is due. The sellers didn't really step up at the ideal location number one or number two, which is why third strike, you're out on any acceptance over 467. Just reinforcing that now that we can see inside the candles on the hourly, right? You'll also notice here that the pullback was perfect, and it actually did find support above the bottom end of this prior balance. If we come in here with the anchored VWAP set, intraday, great rejection here. So long as we're underneath this, we have a daily lower high with acknowledgments that the buyers were looking like they were doing something there, but still a daily lower high. And now we know the key levels to the downside, clearly underneath the anchored VWAP from the Monday gap down as well. All right, so bears retain control via the gap down and what's happening in the post-market here. Let's take it on over to the NASDAQ internals. What we'll find over here is a little bit more of a bullish show of strength on the volume flows, on the advanced decline line closing near trend higher zone. The cumulative build was a little bit more stable into the afternoon, but from a visuals perspective, right, this is great that we still have the Wednesday and the Friday session here. Is there anything that is indicative of new money buyers No, I mean, you would want to see the inverse and opposite of last Friday, a straight 45-degree line getting up and over, we're talking 6,000, 7,000 on the NASDAQ side of things to register a substantial exchange-wide rally that's being broad-based, right? And just to sort of reinforce as well this gap down, this is what we're dealing with in the post-market. I know we've been pointing at, up here, these little numbers, which may or may not be helpful, but as a visual, let's just go full screen and take a look at our good friend, the NASDAQ. And I think that the downside speaks for itself. So that entire rally today, as soon as the tariffs were announced, at least the magnitude of those tariffs, as soon as Trump held up that chart, straight to the downside. Straight to the downside, taking out today's low of day. And it looks like after the maintenance closure, the 6 o'clock open is lower as well and also moving in the downward direction. So once again, this capitulation style gap down could be something that we need to reckon with. And I would reinforce that trade location is still top of mind. Okay. Those are your internals. Let's take a look at the market profile. It's going to be a lot of the same commentary as the S&P, where you'll notice if we do bring in our single prints over here, there we go. The point of control closed above value area was overlapping to up, as well as the value area generally on the week has also been progressing in the upward direction. There's great excess on the lows of each of these days as well, which would indicate that the auction did end properly at the bottom. It's just the fact that we're dealing with a severe gap down as of right now. Let's get back on over to the platform here and let's finish up our broad market analysis with the IWM. Let's give a little reset to these charts. Small caps. They are, what are we dealing with? 192 in the after hours. I was watching the NASDAQ as the discussion was taking place and the broadcast was taking place from the White House, but not smalls. Smalls are looking like they're taking a bit of a beating here, gapping underneath the lower edge of the weekly expected move. 192.35 is the current forecast open, which puts us somewhere around this range, right around in here. Not to beat a dead horse, but of course the trend remains in the downward direction. If this is going to turn into a double bottom, you would have to get over the neckline on this one. It is not quite as similar as the NASDAQ side, where we're giving it the benefit of the doubt over the 198. In this case, you can see that we did reject here. We also rejected these previous lows at the upper bound of today's trading range. So I do think that the sellers they're doing what they should be doing, right? For the most part, as we're considering the levels that are in force, I would want to see any rallies that sort of attempt to move higher. Firstly, gap fill reversal, today's low of day. Let's actually go to the hourly chart as well. Probably need to make a subtle adjustment in here to add in a helper level, if you will, at 196.75. If we can stay below 196.75, that's where the bears retain their edge. Something along those lines. On a gap down, rally, reversal off of that, clearly just a lower high in the trend count. The trend remains down. There's nothing bullish to write home about. If we rally and accept in here, we would start to neutralize. But again, I would say, maybe I would neutralize in here because this is acting as the next lower high in the trend count. Sorry, as I gather my thoughts in real time. I would neutralize in here if we were to produce an equal high, and then, of course, start changing my tone if this neckline actually becomes a threat. It seems a little bit like a stretch of the imagination as of right now. It seems as though the bears definitely have a bit more of a grasp on the market. As we continue on down to the hourly time frame chart, I know we were just here to put that helper level on, but you can start thinking about this. Same concept as the S&P and the NASDAQ, of course, as overhead supply as well. Anybody who's long from this area, anybody who over the last couple of weeks has been looking at the market and saying, hey, this is it. This has got to be the bottom. The market can't possibly get any worse than what we're currently dealing with. Anybody who's buying these lows, anybody who's buying this, thinking, okay, it's going to break out, inverted head and shoulders, it's all overhead supply. On the gap down now, definitively underneath the 198 level, it's reasonable to think that if we rally here, the longs with the best possible trade location will start to close out for as close to break even as possible. What will that do? It'll provide downward pressure to sustain that lower high up against 198 and 196.75. The last thing I want to point out here, let's go to the daily chart for this because we're going to traverse it up to the weekly, is that the failure of this 198, and if we really stay underneath 198 for a lower high on the daily, that gets real ugly from the higher time frame perspectives, such as the weekly. I don't want to go out on a limb and say like, okay, the recession is officially confirmed now, but if we're back in this area for smalls, with the forecast that interest rates are going to come down aggressively, we'll get to the Fed tracker tool in a moment, that's an ugly, ugly picture. It's a very ugly picture in recession, right? And I'm sure some people in the comments are going to be like, what are you talking about? Recession's already here. Why are you behind the curve? Okay, it's fine. It's fine. Rejections towards the 204, that's sort of that neutralization level we were just talking about, obviously on the gap down getting underneath Monday's anchored view app. That speaks for itself. We're still in bearish trends across the board here on small caps. Let's jump on over to the RTY side of the market internals. Similar story to the NASDAQ, where you have inflows, decent look out of the advanced decline line, but your cumulative build here is not really helping the case for the bulls. If we zoom in on the after hours, it just continues to be a bloodbath for the small caps, which are typically the most economic sensitive, the most sensitive to economic conditions, I should say, if we're using proper grammar. Let's take it on over to the Rusty Russell market profile. Anything to bring you over here in terms of updates? Not really. I'd say same commentary, so we'll save the breath in terms of the S&P and the NASDAQ. Same story. Okay, let's get back on over to the platform. Let's take a look through our sectors and the performance to begin with. So let's just throw up an S&P chart in the background here as we do it. Weekly performance so far was pretty solid, straight across the board. However, what do we know is always indicative of volatility and much more so unhealthy markets? It's correlation, right? If you're seeing rotation is a healthier market where there's some safe havens, there's some things that are not safe havens, but after you've sold everything and you buy some things back, right? If you sell everything, then there's nothing left to sell. You buy something, right? So everything up off the lows here makes sense in terms of volatility and correlation, not necessarily rotation getting us out of this funk, seeing different pockets of strength. So yes, discretionary is up here, and yeah, Tesla had itself a day, up 11%, and we'll get to that. But overall, discretionary tech, semiconductors, all of these things are getting absolutely beaten down in the after hours primarily, and we'll get into the chart in just a second. The import tariff on Taiwan in terms of semiconductors is going to be brutal. There is basically going to be zero incentive to build data centers here with the import on semiconductors. They need to be, and you know, this is the argument, right? This is the whole logic behind it in the first place, is need to build them domestically, need to manufacture that stuff domestically, incentivize the data centers to actually be built. The trouble with this, and you can argue with me in the comments about this, I'm not an economist, I'm not a fundamentalist, so I don't really have a stake in the matter. It's just the environment we're in. The argument would be that's great, and it would be awesome to bring that stuff to the States, but what happens if the next administration says, we're going to go back to free trade. We're going to undo these tariffs that have been imposed if they stick in the first place. We're going to undo that. Now there's zero competition, right? And everything from an import perspective will be far cheaper than the investment we just made into domestic manufacturing plants, building these things here, so on and so forth. So something to consider, right? And the timeline here is huge. There's no bearing on like the next 24 hours of actual trade, tactical, what we're dealing with. So something to think about, something to chew on, but let's get back to being tactical. In terms of underperformers, bonds, healthcare, staples, it looks like a risk on rotation, but it's not. It's not, right? So let's get into these. Let's take a look. This balance range, double bottom, maybe. However, as we're just evaluating where the post-market is right now, we're 10 handles lower. 10 handles lower brings us straight back to the equal lows. I don't know about you, but this is a textbook bear flag. Through the lows, sayonara. Goodbye. Nice knowing you. Bearish pressure for the S&P 500, right? Let's move along to the tech sector. Did not make an equal high back here. It moved back into the balance range, but where are we in the after hours? We're down at 200. That's down here. Is this a lower low? Is this a lower high? It certainly aligns more so with the bearish sentiment, right? Let's move along. Semiconductors, where semiconductors are brutal. Down 10 handles in the after hours, right? 10 points, handles, dollars, all the same thing if anyone's curious. Currently trading 204. 204 in the after hours is underneath Monday's low. I don't know about you, but it looks like here's your distribution. Here's your Wyckoff lower high. This is a lower high even underneath this previous low, right? So any rally rejections of 211 start to look dangerous. Where do we change our tone? Show me some acceptance. Show me something that looks like this. Maybe we start to build out inverted head and shoulders only if the fundamentals align with walking back some of the tariff news that we just got, right? Industrials, where are we? 125. 125 puts us, my goodness, down here. Does that look bullish? Does that look bearish? I mean, you could maybe build the argument that it's an extended gap down. It's going to give a gap fill reversal. Some sort of correction to the overnight inventory would be fine. But what's the opportunity? Just a lower high here. So as you're perusing these charts as we're going through together, at the top and forefront of your mind, you should just be thinking, is there anything here that has the potential to change the trend? To me, the answers are no. Let's take a look at financials. A little bit insulated, not much, but a little. We are opening, or at least the forecast in the after hours is 48.75s, close to this area in here. Not quite an equal low to back down here. However, The argument we've been making, and we really see this over on JP Morgan at 248 is the key level we've been watching, is that this lower high is kind of the nail in the coffin. The buyers needed to sustain consolidation here, heading into financial earnings to look something like this. With the gap down this, what should be tomorrow morning, you're actually underneath that key level, coming from, right, the neckline, if you will, of the head and shoulders after the election gap up, right? So that's the key level there. 49.60 will continue to be a watch. We're obviously opening underneath. That's bearish. Materials smacked down at 83, pretty wide through the spread here, but new lows, no trend change on that. As we look at energy is coming in a little bit as well. Nothing safe here around 91.67. So I suppose deflationary quotes, big air quotes on that one, just backing off the top end of the range. This really, show me something out of the range. And we've been saying this for a little while now, but that's really energy. Communications moving lower, of course. No safe haven over here. Looks like we're currently 93.70 by 94.46. Somewhere around in here. Daily 200 SMA. I mean, simple pattern perspective, head and shoulders, under the neckline, sayonara. The thing everybody always gets caught up on is, let's go to the NVIDIA example, right? The NVIDIA example was, hey, look at this big head and shoulders, and then, it took a while to actually play out underneath this, just ultimately acting as overhead supply. So I'm not saying that communications need to have the same fate. We should go here and then expect here. But generally speaking, if we wick the neckline, a first test of the 200 SMA and set a counter trend, it wouldn't really unwind the trend, which is down. We could still seek a lower high in the trend count, right? Let's move along to utilities. Nothing to talk about over here. Real estate not helping the case. Staples, how are we in the after hours? 80 brings us back down towards this area. Pretty important inflection point from this overhead supply perspective. I would maybe be open-minded to an entanglement high or low here, something along these lines. We'll watch out for it, but not going to move the needle too much for the market itself. Healthcare, Trump actually made quite a bit of comments about the healthcare sector in his speech today before the tariff announcements. Saying that we really can't sustain ourselves and we import all this stuff from a drug manufacturing perspective. Anyways, this 141 in the after hours, 143, so pretty spready, not really all that impacted. The thing I would be watching for is whether or not this continues the pressure in the downward direction. So I would use 143.85 as your arbiter of price. If you're below that neckline, I would continue to use this as a bearish pressure for the market, which we know this is D for defensive anyways. It's now worked its way back up to the third heaviest weight sector by market cap, dethroning some of the XLY degradation we've seen with the Tesla 50% haircut. But regardless, use that 143.85. If we're below that, just bearish pressure for the broad market. Let's take a quick glance at bonds coming in aggressively today and in the after hours slightly higher. 92.70 is the current look. 92.70 puts us on par with these equal highs. Sort of the market still suggesting that the Fed is going to have to intervene here because things are breaking. And I would say the unwinding of the move that we saw lower today is actually sort of the market being fearful of the tariffs breaking things even further, of course, causing much higher inflation, which you might say, well, isn't that a catch-22? If this is suggesting that we actually lower rates by moving higher on the bond yield, well, the yield moves lower, the bond actually moves higher, right? Isn't that a catch-22? Yes, but this is the market saying that Powell is going to have to intervene because things are going to get so bad that we need Fed stimulus, right? Growth is going to slow down. It's really a growth scare, which is the stagflation argument we've been setting forth over the past couple of episodes. Let's get into some sector ratios and just take a quick glance at these. If you're not familiar, check out the video tutorial in the top right-hand corner. Bearish still, big rejection opportunity here, bearish. This looks okay, and we know that financials have been sort of the okay-ish spot, although we just acknowledge that they're opening underneath the key level. D for defensive, not overly concerned. This looks like risk off. This looks like risk off. Even real estate, like a hard asset, seen as sort of defensive risk off there. If we look at the specialized ratios, no help, right? You're seeing this risk off, risk off, risk off on new lows, risk off on equal lows, opportunity for lower highs. This, of course, major risk off out of ARK-K. No dice over there. Let's take a look at the Dixie. Where is it in the after hours? We should probably just maybe use some proxies for this to get a sense. Let's go 6E for the euro, see what's going on with this in the wake. Oh, it might have been the fact that we were looking at the weekly chart. Anyhow, look at this volatility. Ultimately, euro seems to be kind of unchanged to some degree. We'll see if that changes here in the short term, but you would think that these domestic currencies for other parts of the world would strengthen on the news. So we'll see how that plays out. Let's take a look at, let's jump into interest rate. Oh, gold first, actually. A little all over the place here in the back half of the video. That's all right. Gold still suggesting a little bit more risk off. If we look at let's go to an after hours chart here, and let's just highlight that on the futures. Let's highlight so you can see where the announcement actually took place. 4 hour, let's go to a 15-minute. So here's the announcement, of course. Gold saying, whoa, risk off. This is kind of a little bit more neutral now. Generally, if you do something that looks like this, your ratio is going to continue to move higher. Just noting that gold is unchanged and the S&P is dropping like a rock, right? So still looking more like risk appetite is diminished based on that gold relationship. Interest rates here, we know are likely going to move based on the TLT that we just saw, lower, back down towards these equal lows. Speaking of, let's just take a look at the Fed tracker tool and get a sense for what that's pricing in as of right now. We can have a little bit more of the fundamental conversation. Let's drop in our year marking line. We're still dealing with 1, 2, and 3 cuts for 2025, which is one more than what the SCP outlines. And this has been all over the place. I wouldn't be shocked if this continues to bump higher as we move into tomorrow's session and these Fed Fund futures start trading in response to the actual tariff news. Let's jump into the calendar over here. Some decent numbers this week so far from the jobs side of the market. You can see that the ADP non-farm came in pretty solid this morning at a 155 versus the 118 expectation. And the previous even got revised up from 77, I believe it was. Yeah, 77 to 84 here is not bad. So the labor market not breaking is a good thing, and that gives a little bit more of an opportunity to keep rates higher for longer to try to combat any transitory inflation from the tariffs that the Fed is thinking about here. ISM manufacturing PMI, not the greatest read at 49, missing the expectation and in contraction territory. The JOLTS number, though, not terrible. Not a huge miss there, although certainly job availability is slowing down. We will be watching for the unemployment claims tomorrow morning. See how that maybe influences our next round of the full Monty labor report. We know that that is on Friday. Coffee and donuts on me up in the penthouse on the 8 or at the 8 o'clock time frame on Friday. We'll watch that. Also, the people spoke, the people voted. We'll do a live stream for Fed Chair Powell speaking at 11:25 on Friday. So come hang out with us for that as well. Mark your calendars that tomorrow, your biggest bit of volatility is probably coming from the services PMI. The forecast is for a decent print here at 53 flat, and we know that the miss over the last couple of reads in here have really caused the market to be on edge. So please keep a keen eye out for ISM services PMI. That's tomorrow at 10 o'clock. We'll remind you, of course, in the pre-market prep. Let's get into these tariffs. And let's start talking about why these really have no, in my opinion, maybe I'm just an idiot, but they should have no staying power. I mean, we're talking about a 34% tariff on all goods from China. We're talking about, let's go to Taiwan for the semiconductor conversation, right? 32% tariff on all things imported from Taiwan. I mean, this is just, they're huge, huge numbers. And you might see this column and say, well, you know, these companies or these countries are charging us a egregious tariff as well. This is sort of a debatable number. China outright is not charging a 67% tariff. As a matter of fact, if we look at this table over here, we can see that China actually falls into the bucket of roughly about 2.2% tariffs on, in aggregate, the goods that we import there. And you can see up here, this is trade weighted, right, over all goods. So every good has a different tier of tariff, so to speak, associated with it. In aggregate, if you total those things based on their weight in terms of how much of each thing we import in each category, right, just doing simple averages here, that's the tariff, right? So 2.2% from China. And the proposition is that we're going to go to a 34% reciprocal tariff? I mean, when you frame it that way, you're like, no wonder the market just fell off of a cliff in the after hours when that was announced. So you can feel free to peruse through some of these things. To me, the most important ones are really just that Taiwan from semiconductor perspective, the China from just global trade perspective is pretty crazy. Of course, you can think about, where is it in here? I thought that they listed, maybe not. You have the European Union. I was looking for Mexico and Canada. It's probably right in front of my face, and I'm just not seeing it here as I'm trying to do it in real time. I'm not going to waste your time and pick around for it, but for the most part, you're going to want to watch this table here and see how quickly these things get walked back or like they're used as a negotiation tactic. So we'll see. My point being is, and this I hope I expressed clearly in the initial S&P analysis, is that worst case scenario is on the table right now. The market gap down, if it gets really severe for tomorrow morning, that's where if things start to get better, if they peel back some of the tariffs, that's where we can easily see a move in the upward direction. Like, okay, thank God it's not nearly going to be as bad as we thought, right? The base tariff, just to cover this quickly, the lowest tariff that you'll see in all of these is 10%. 10%. Now, what does 10% look like relative to the entire list here? It's higher than the highest imposed tariff on the United States from Brazil in aggregate at a 7.3, right? So this is obviously we got much higher than 20%, but the base, the very minimum, is at 10%. So wherever that might be, I don't know what the scale is on this thing. You can clearly see that 2.2 to get to 7. This must be like logarithmic or something of the sorts. You get the point. Aggressive, almost a little crazy, and we'll see how the market digests that over time here. If it sticks, hey, it sticks, and expect this number to continue looking like this, I would imagine. Why would I say that? Well, because imports have been the biggest detractor of GDP. This is the Q1 estimates for 2025. If we just open up the subcomponents, ever since this tariff talk really grasped the market, take a look. Who's gonna want to do this stuff? Look at our exports here, right? And the imports, of course, as well. Who's going to be in trade with us as these things are just falling off of a cliff? Nobody, right? So that's something to be thinking about. A induced recession based on tariffs, and then having to walk these things back. We shall see. We shall see. Let's take a look at the earnings calendar. Restoration Hardware after the close today was the only thing that we really care about. Upper echelon of consumer. We'll check in on them and see if they're still buying $20,000 couches. Let's jump quickly on over to perhaps RH. And Restoration Hardware, not a shocker in the post-market, piled on top of earnings with the tariffs, because you better believe none of that, I shouldn't say none, but not a majority of that stuff is manufactured domestically, down at 185.50 from 250 basically as of the close. Just to give you an idea, that's a forecast open somewhere down around these lines there, right? Pretty aggressive out of RH. I'll have to dive into the report after to see if there is any qualitative data about the commentary in there. Let's move into some of the back half of the video analysis on risk appetite. The TLT ratio to the S&P, I would have to imagine tomorrow sees an aggressive uptick there, suggesting risk off. Flight to safety is in play. The classic saying, right, is that they will crash equities to save the bond market, right? Let's move into our bonds relative to themselves. We'll see how the long end of the curve performs, even though it seems as though the Fed is going to be forcing their hand here for more rate cuts. This, for now, continues to suggest that the long end of the curve is doing the heavy lifting. Let's take a look at credit spreads. These likely see an uptick tomorrow on increased volatility, but for now, they were suggesting double tops. And if they had broken back down underneath the necklines, underneath the 50 SMAs, I would have been a little bit open-minded to this being double bottom. It's just not the case anymore. The tariff news has destroyed that, so to speak. Bitcoin on the tariff news was firstly higher as Trump was sort of dilly-dallying, and then when the numbers came out, straight to the downside. The Sailor shift still signaling a bearish indication here. If we look at breadth, subtle improvements, but still under the 50% mark, and a subtle improvement out of new highs versus lows, but still under the zero mark. So in the intro, I also made another very pointed comment. I said the bear technicals have still been working. There's nothing here that has suggested it was time to get all aboard the long train and, oh my goodness, the market's going to go print brand new all-time highs, right? It's just not a conversation that we've been having. We've been saying that the bears are in control. I'm not even going to get into it, right? They call me the perma bull of YouTube for a reason. When the perma bull of YouTube starts talking about bearish things, I don't know. I try to be objective and just read the data points. It seems like it's probably worth paying attention to. RSP. Small divergence with a higher low happening here. I don't think that that's going to stick into tomorrow's session. We're opening back down on the equal low practically in the after hours at 170 by 171. Let's take a look at the QQQE. Underneath, clear opportunity for a lower high. Right? This, although it didn't, it's not a bullish divergence where we're saying, okay, a bottom is in, this pattern should play out for higher. Not there. Let's move into the volatility side of things. VIX probably opening higher tomorrow on new updated information, right? That the tariffs are out and higher than the expectation. If we take a look at the VVIX, Probably another acceleration to expect over here. If we look at the specialized vol indications, this is this is awesome because volatility futures are obviously open right now. This was originally suggesting that we were going to be here. I almost wish I could go back in time and cause the close, the current reaction, to be where it was. It was up here. The fact that this is making a new lower low underneath this backwardation from back here tells me everything I need to know about the volatility for tomorrow. If we can produce a severe gap down, I will be looking for the capitulation style, like, oh my God, this is awful, buy the dip style gap fade. If, here's a key, the one-day VIX is fading off of the open. It's not often that the one-day VIX fades and actually prints a red bar. You can go back here and you can look, right? All of these days look green to me. If the one-day VIX is fading, that would be an indication to buy the gap. Another way that you could do this, if you are more so comfortable with the VIX itself, is if the VIX is headed lower as the market is moving lower on, let's just say that we open on a gap down, the market drifts to test the overnight low and the VIX is also moving lower. If we pass back up through the opening print, that's where I would want to be a buyer. Versus if the broad market, in this illustration here, for example, is the SPY, let's say, or the ES futures, whatever you want. If the SPY is moving lower here and the VIX is continuing to move in the upward direction, I would be less likely to buy the gap fade and look for the gap to close overhead. That's a little tidbit you can always use when it comes to looking for, is this the low? Is this the capitulation style? Gut-wrenching, oh my God, it can't possibly get any worse, right? That's that. Let's quickly rip through our core list of companies. Let's see what's going on from this point of view. NVIDIA kicks us off, and of course we want to be mindful. I almost just want to go to this spread over here. Let's go to this, such that we can see the after hours damage that's been dealt. So very likely a gap down opening somewhere over here. I would primarily be interested in gap fill reversals under 107.15, targeting 104.75 on the equal low. If it's a gap and go, if we end up opening down here, a Brigade bolt lower high under the 104.75 violates the daily equal lows here. We're looking for downside into, there's some room to fall. Not 196, but rather just 96.15. Let's go to a daily, make sure we're not missing anything. Ooh, no, we're not. We are not missing anything there. Even if we did pop in another level, maybe we have about $101 in here as a helper. I'd be curious to see what that exact reversal level is. Let's maybe take a look at that in real time here together. Let's go back to an hourly now, and we're going to need more than 90 days. Let's try the 360-day chart, and let's just have ourselves a look. So this is the head of an inverted head and shoulders. Let me remove that and more appropriately dub that as this at 101.75. 101.75 would be the level that I use if we are seeking some sort of target before 96.15. All right, let's go back to a daily. That's NVIDIA. Let's move along to Microsoft. Severe damage being dealt, 377.25 being obliterated here in the after hours. So we're approaching that weekly cliff. We're not through it all the way, but of course, gap fill reversal just provides another lower high. I think the main thing we're thinking about here, the main thesis, is that gap fill reversals offer lower highs. The trend remains down, and we're looking for continuation. If we do drop the weekly cliff, there's quite literally not much here until we're at 345.15. Right? If we just zoom out on this might even require the weekly chart to talk about. There's that thin structure. We pointed it out on Saturday. Let's move along to Apple. Big destruction happening over here in Apple, opening underneath 210.65. Ouch. Underneath this weekly local low from back here. Let's go to a daily. That puts us, wowzers. Lots of overhead supply. Box 1, box 2. Clearly, I would expect 210.65 to be the first big area of battle. If we stay below that, lower high. If we rally above that, I would have less interest in 214.15, and I would primarily be concerned about on the hourly. You can see this. Let's go back over here. I would start looking for this inflection point here, 219, right? This gap down open really rallied and found the higher low above intraday, and this pullback right around in there, the opening print of Tuesday low as well. All right, that's Apple. Next up, Nancy, Amazon. Taking a beating down here. There's some additional conversation around Amazon and TikTok and the possibility of gaining some competitive edge there by sort of going through with that acquisition and having ownership basically to TikTok shop. So we'll see if that does play out ultimately. But for now, opening on a gap down, 184 is the intended open at the equal low from Monday. I gotta say, today I was honestly looking for much more of that rejection off of 192.25, and it's just, you never want to revenge trade stuff, and we'll have to be careful to not do that tomorrow, but a little disappointing to see that it just broke right through, and then the after hours is what it took to substantially rotate away from the 192. So anyhow, what we'll be looking for is any gap fill reversals, lower highs. It's the same old rinse and repeat that we've been talking about so far. Something along these lines keeps you underneath 187.65. The lows down here, 180.29. Goodness, who let that slide? 180.25 would be the next target down below, underneath 184. Where would I be bullish? You'd have to show me acceptance over 192.25, which it seemed like it may have been a conversation before the tariff sort of destruction, if you will. Let's move along to Google. Google is back down towards this gap close area, equal low in here. This to me is a much cleaner candidate for a lower high, noting that it never really got into this overhead range there. So 156.65's lower high rejections. If it does rally, right, looking for that still. This gap close area is becoming a little bit less important. Let's remove this. Let's clean this up in real time together a bit. Let's go 151 flat. Let's go with a clean gray. There we go. And this is good. So if we rally off of this gap fill reversal, lower highs, if we go through, right, we're talking about 147.75 on the downswing to give you some levels. Metaverse, I was open-minded to being neutral over the daily 200, but no longer, obviously, on this big gap down. Underneath 565.65, I think that the door is open for rally rejections of this level, to be quite frank, at 565.65, because if we go to the daily, 565.65, oops, sorry. That's on me. 560. I was thinking the 577 level. I guess it still just is the daily 200. I was going to say the bottom end of this range, right? 565 is the midpoint before we really started to take off. So I'd rather be accurate and not try to look like a hero in hindsight and play it off cool. 577 is the level that I, in theory, was going to reference. So that would mean this instead of the 565 rally rejection. Let's move along to Tesla. 11% to the upside today, giving back a decent amount of that, but not really opening on a gap down as of right now. There's no forecasted gap down out of Tesla. So I've said this over the last couple of episodes, right? This is the dark horse. This is the double bottom. If we could get the Brigade bolt over the neckline, we were going to rock and roll. And we're rocking and rolling. It looks like we're still over the weekly key level. Tesla as the dark horse can emerge slightly victorious here if you think about it. Even from a tariff perspective, they're manufactured domestically. They're not going to be subject to those tariffs on imports, right? So something to think about. Key levels, you can see them here, 263.25. We have 274.25, 286.85 top end of this most recent range. I would be back to the bear side under 250.50. Moving along to JP Morgan, we've got ourselves that 248 level we were describing on the XLF chart. We're still below. This is the threat for that lower high. It doesn't really look great, if I'm being frank. It does not look great. We'll see what earnings bring us in the next little bit, but for now, this is downward pressure for the S&P, as we know. Netflix 950, nice rejection towards the highs of today's session, and clearly opening on a gap down like everything else. Neckline of this as a head and shoulders underneath 924, so rally rejections of 924, keep the bears in play. Let's get into these 4 trade ideas and then you're on your way. CRM is the first one on the chopping block. This was going to be bearish even before tariff news was announced here. Looks like this is not immune to the gap down. 262.80s is the current open. I was going to suggest that this Brigade bolt lower high underneath the bear flag was what I was interested in for a potential risk reward situation. Obviously, with the gap down forecast here at 262.25, it sort of leaves it open to interpretation. The next major level to the downside at 245.50. If you're looking for an equal low flush, that's really what you have on the daily time frame. So that's CRM. That would have been a short setup. Next up, CAVA. What do we have over here? This would have been a long setup if tariff news went better than expectations. It clearly didn't. So it was going to be double bottom, thin structure retracement up into this previous shelf of overhead supply, 111. Doesn't look like it's so much in play. We're opening near these lows. I would say keep this one on your radar. If it does build out cup and handle, if it's maybe that higher low double bottom we were just talking about, let's just say, let's theorize here. If tariffs go better than expected and they get walked back sooner than expected, CAVA could be a candidate if the market finds a bottom over 95. So it belongs somewhere on a watch list just due to the technical structure that's here and what it's suggesting, but I'm not sure it's in play for tomorrow immediately. That's CAVA. Next up, we have TSM. Of course, just seeing some of the downside impacts of the tariffs already, but this is very similar to TSM and CRM are similar because of this Brigade bolt, right? The rejection of 170.75 would have been what we were looking for, and clearly we're opening on the gap down already. So rallies for gap fill reversal, rally for a 170.75 rejection again, equal low breakdowns underneath 160.50. Do we have the next downside level? We do not. Let's do this together so we're not leaving anybody out to dry. I would start with something along the lines of 155.75. Let's go to the hourly and see if we can refine that a bit here. Can we get the 360-day chart up just so we can actually access what these numbers were? That's actually pretty darn good. I would go up a hair just to not 3, but rather 156 flat as the number here, capitalizing on this low and some of the inflection points from this interaction back over here. All right, 156, that next target, about 4 points underneath this 160 floor that we just established. That's TSM. Then we have PayPal, PYPL. There we go. And let's go to the daily and let's see what we can see. Do you see the theme? Do you see the pattern? Quite literally, it's the Brigade bolt underneath the bear flag. Obviously rotating away from it already. Not sure that this is even playable via the gap down on a short side setup. You would have to wait for either another lower high or Brigade bolt underneath 63.80 at this point. What would our next downside target be? Oh, this is the joy of having major catalysts like this really throw off the trade plans. I'd be thinking about 61.75. So we'll reassess the validity of these setups. I think that obviously all the commentary on the S&P still stands. We'll update that as of tomorrow morning's pre-market prep at the 8 o'clock time frame. And that is what I've got for you in tonight's episode of the Midweek Market Update. If you enjoyed the video or learned anything new, if you enjoyed the commentary, if you enjoyed the breakdown of the tariffs, let me know in the comment section or by giving the video a very simple thumbs up. As we've said multiple times, we will be live tomorrow morning at the 8 o'clock Eastern time for our pre-market prep. Hope to see you up in the office. Remember, Friday is coffee and donuts on me for the full Monty Labor Report. I hope you have a green trading week, and I will see you in the next one.